In many ways, retirement is all about freedom. Freedom from working, freedom from deadlines, and freedom from responsibilities. Unfortunately, the freedom does not include taxation. Actually, taxes can increase while someone is in retirement. Here to talk about this is my guest, Michael Budnick, who practices in Burbank, California, and Austin, Texas. So, Michael, I'm sure that you see some clients who become surprised in retirement when they find themselves in a higher tax bracket. How can that happen, and how do you manage that?
Sure. Well, I think what a lot of people don't realize that I see every day in my office is that they, with their retirement plan, your 401k and IRAs and such, traditional IRAs, all of that money that comes out of those plans is taxed as ordinary income. And I really don't think people think about that, and those particular dollars are taxed at your high marginal tax bracket, and so that really it gets factored in when you look at your overall income. And also really important to look at Social Security, because there are ways to make sure that you can actually take dollars and convert them properly in a way to actually mitigate or minimize some of the tax burden that you have, and really to put more dollars in your pocket.
So one of the least popular aspects of an IRA are the required minimum distributions, or RMDs, that start at age 70 and a half. Are there ways to minimize the taxation on these?
Well, there is, and what I like to look at is finding a year with a client where maybe perhaps they have a lower income year, and what they can do is they can convert that traditional IRA to a Roth IRA, and yes, they're going to pay the tax on that Roth IRA, but from that point forward, they no longer have the required minimum distribution issue. All the money grows on a tax-free basis, which, if you're looking to grow an asset, having it grow tax-free is really good. And I'll tell you, your children that you're going to leave that money to, the best money that you can leave is the tax-free money that you would have in a Roth IRA. So if you're also looking for legacy for down the road for your children, it's absolutely a really worthwhile scenario to look into. And you don't want to do it all at once, and it requires proper planning to make sure that you understand the effect that you're gonna have when you make that conversion from a traditional to a Roth. But it's a process really worth taking a look at, and will work really well over time done properly.
So how do you know if a Roth conversion is the best idea?
Yeah, it comes back to the goal and really of the client. It's their goal. In other words, are they looking, is that money, number one, are they looking to take that money out and spend it down earlier on when they retire? Or are they really looking to enable that asset to grow past 70 and a half? And are they looking to have that asset, again, passing it along to their heirs? So there's a number of questions that really need to be looked into in the process to make sure that it's going to be in the very best interest of that family in doing that.
Great, Michael. Thank you so much.
Thank you.
My guest is Michael Budnick. He practices in Burbank, California, and Austin, Texas. And this is Retirement News Online. Thanks for watching.